Hi, Peter Leides with you here. This update is going online Saturday, October 5th. It's not really an update, it's an explanation. We've had a lot of questions from people about what is your theory about how the market works? What are these offsets that you're doing? What is it all about? So, this animation that we're about to show you is actually online for those of you that are subscribers. It's in the group of videos that subscribers have access to. But we're going to repeat it here, and we're going to do a voiceover narrative on a slow basis just to go through things step by step and show you basically what our theory of stock market movement is. So you're about to see a sine wave animation, theory of market movement, as you can see on the screen. This is what appears to be a typical stock chart. You have jaggedy movement, you form a support line, you break the support line, prices go down. In the downtrend, you can draw a downtrend line, place it on the first couple of peaks, and you come up to it. You come up to it a couple of times after that, can't get through. Finally, you break above that trend line, you start to move to the upside, and you start forming it's a stalled formation and a triangle formation. You have a 1, 2, 3 tops here. You've got a couple of bottoms you can draw a line on. There's your triangle. You break out of it to the upside, and as might be expected, prices really take off again to the upside. So it appears to be a typical stock chart. But what is it? Let's give attribution, by the way, to this theory and the way I've constructed these charts to a gentleman called Claude Cleeton, Cleeton, who wrote a book a long time ago called The Art of Independent Investing. So if you want to look for that book, I don't even know if it's in print anymore. This was his concept in terms of showing combinations of cycles and how they create market movement. So we're going to show you the first cycle here. This will be the longest cycle. Call it whatever you want. It doesn't make a difference. You can call it the 4-year cycle or the 17-year cycle. It's the longest of the cycles that we're going to show you. So the space between the tops and the bottoms is equal. It's a perfect sine wave. And then to go along with it, you have another sine wave. It's shorter in time in terms of its tops and bottoms, and it's smaller in magnitude. And then add a third sine wave. That's the gray one that you see traversing up and down perfectly from left to right. And we're going to do one more, the shortest one of all. Tiny one goes up and down the same rate, virtually perfect sine wave. And so you have 4 sine waves, some of them going up at one time, others coming down. You can see here that this orange one is coming up right as the bottom is occurring. So chances are, even though this is a long-term cycle, the bottom in the stock prices will not occur at the exact bottom of the longer cycle. The other thing to present to you is what we call fundamentals. Fundamentals are always working on stock prices and stock indexes, but they work in a smooth fashion. They work basically in almost a straight line that changes its angle of ascent and descent from time to time. But we're going to show you a straight line that theoretically would represent fundamentals for this particular, call it an individual stock or a stock index. So we have 4 cycles and a fundamental line. We don't mean to imply that that's all that underlies all stock price movement, whether it be indexes or an individual stock. This is a hypothetical to show you the theory. So what happens when you put all of these together? When you add up on each point in the horizontal axis, the x-axis, you add each one of these, the 4 cycles and the fundamental line. What does the combination of all of them look like? Well, I'll show you. This is what it looks like. This is simply a combination of all the cycles added together with a fundamental line. This was the original chart we showed you. Here's the downtrend. Here's the triangle formation. Here are the short-term support lines that are broken. So it's our representation of how stock prices move. Just a couple of more charts to show you, and that's what the offsets are all about. If you have a 20-week cycle, and this is again an idealized sine wave of 20 weeks duration, hypothetically. Distance between the tops, 20 weeks. Distance between the bottoms, 20 weeks. If you move that cycle over 10 weeks, the half span of the cycle, this is what you end up with. Here's the original cycle, solid line. Here's the half span. You see a bunch of little squares. And look at what happens. What happens is the original cycle moves up and crosses the offset at exactly the halfway point. Same thing happens on the way down. It moves down, crosses the original sine wave at exactly the halfway point. Well, let's take one more step and look at it in terms of a stock chart. This is obviously an idealized stock chart. Prices don't move from, let's say, 9 to 21, back down to 9, up to 21. But it's idealized to show you how we do the price projections. Again, if this is a 20-week cycle from top to top and bottom to bottom, then we move the midpoint of each one of the bars forward 10 weeks, and look what happens. Prices come down, they cross the 10-week offset at exactly the halfway point. 15 is the halfway point. 6 points higher was the high. 6 points lower is the low. That's 9 and 21. Take 15 plus 6, 15 minus 6. And so this is what we do when we show you the offsets that we do our updates with. So obviously there aren't just 4 cycles that determine stock prices. There are a multitude of cycles, and we use a multitude of half span offsets to determine the price projections for each of the shorter cycles. They're not going to be exact because even as the shorter cycle is working, the longer ones are working around it. So they may throw it off a little bit. But the technique of measurement that we do, as I hope you've noticed by now, works out to be quite accurate. That's the whole theory behind cycle price projections. Thanks so much for watching. Hope you enjoyed it. Refer back to this in the future if you want.